Hello, everyone. Welcome back to another episode of Let's Talk Housing, episode 40. I don't know how we got here so quickly, but that's absurd. My name is Brendan Thomas. I'm the co host here alongside Stephen Thomas, chief economist and founder of Reports on Housing. Today, we'll discuss the most recent economic news and statistics, like usual. We'll touch a bit on foreclosures, a different start to 2025, the California exodus, and much more. But first, Stephen, what is going on in the Thomas household?
First, before I jump into that, I just wanted to say that our thoughts and prayers are for everybody in Los Angeles County. Both of the big fires. We actually have. My wife has an aunt that has a house that is really close to the coast, and as part of the big fires, not the Altadena fire, but the other fire. It took her a week to find out whether or not her house had even burned down. So awful that they even had to deal with something so tragic. And there's going to be a lot of good things that come from this, but for right now, it's all about getting these people finding their next places to live, as well as getting everything cleaned up. And it's just going to take years to rebuild. So hopefully, government can get out of their way and make it a little bit more streamlined and easier for these people to do it. Of course, there's going to be different codes and things like that. We'll learn from everything, but man, that's just really hard. So we are definitely praying nightly for them, praying at church, and just to know our hearts and prayers are with these families and the tragedy, and also everybody that's on the forefront of fighting these fires. Our son, your brother, just became a firefighter, and this puts it right in the limelight of, boy, this is what he's going to do. So Kyler got hired on by Torrance Fire. Half of their engines were actually up fighting the fires, and he's not yet a full-fledged firefighter. He has to go through their academy, but he will be an engineer for that fire for Torrance, and boy, that just puts everything into proper perspective when you see these people work these 72-hour shifts that they're working and getting very minimal sleep. So we're definitely praying for them, and our hats off to them. We're thinking of all of them too, and all the people that are volunteering. It's everybody's coming together. We're going to see some good human side stories, not the other things that are going on, like price gouging and things like that. But we'll get into that. But now, as far as what's going on at the Thomas household, it was my birthday last week. It was my wife's birthday the week before. It was Brent Mason's birthday the week before that. And it was for us Christmas, or New Year's, and then Christmas. So it's been one thing after each week. It's another thing and another thing and another thing. And yes, we're done now. All birthdays are done. And this is MLK weekend. Now we can just kick back and, as a family, and just go back to normal things. So there you go. That's what's going on for us. But how about you, Brennan? What is going on in your neck of the woods?
Man, not too much. Yeah, it's been a lot of family time, kind of like you described, where we have so many birthdays, and I usually just acknowledge that this time of the year is just constant family time, which I love. I love seeing our family. It's a lot of fun. Other than that, I mean, it's been doing the same old, been working a bunch, and maybe going on a vacation soon. We're gonna have to see. I'm excited for that. I'll keep everyone in tune for
It's because
where I may go.
you're overworked.
Not
Overworked.
my fault. Steven, I wanted to start by asking you what is going on in the real estate world, because we've seen a wild couple of initial weeks for 2025. So, what do you have to say about the real estate market entering a couple of weeks in?
Yeah, so man, I had a presentation today. Thank goodness it was at 11:30, because usually I like to get the latest and greatest news, and I was doing this one in Orange County. So we had downloaded all the information, all the numbers, and this morning I was looking at what had happened in Orange County as well as in LA and San Diego. Then I was looking at all the counties because it piqued my curiosity. And this is a way different. There's kind of like, somebody said, how do you describe it? It's kind of like a shift in the marketplace. And the shift is that we're starting off the year with 7% plus interest rates. That's shift number one that we're not accustomed to. Shift number two is there are actually, I had a look at it. So because we're above 7%, we're looking at very, very similar year over year pending sales data. And we already had more homes to start off the year. And then now I'm looking at just the first couple of weeks, we have more homes coming on the market than last year for January, just the first couple of weeks. And you compare that to, there were more homes that came on in 2024 compared to 2023. Easy to beat. This year is beating last year. So there's even more homes coming on the market, yet demand pending activity is stuck. And it's stuck because of these 7% plus interest rates. So what's happening really fast? Something I have not seen in the data. You were pointing out some things because we're trying to figure out what this is similar to in Orange County. I mean, you have to go back to like Great Recession days to find anything that's even somewhat similar. I think what was the other year that you found that was somewhat fit? Oh, you were on mute. So
2014. Oops.
So in 2000, if you were live, you could actually see him. He was, if you're on YouTube, you could see him, and he had it on mute for a second. But I am, so it was 2014. So we saw something similar in the Great Recession years, 2014, a little bit. But really, this is kind of an odd year start. And that's because these extra homes have accumulated, demand the same. So we're seeing market times actually rise fast higher. There's only a couple markets that didn't rise fast higher, and that's because they're already extremely high to begin with. So the combination of the two factors on top of each other, whoa, boy, just looking at higher inventory and demand the same, it's a different marketplace just to start off the year. That doesn't mean that's how the year is going to unfold. It means that from here we're going to get inventories that come continue to climb, but maybe not quite as much because demand is going to go up. So we're going to see those two. We're going to see demand go up as well as inventory not stay so low like it is right now. And then so when that happens, we'll see the market times come down. It's just not going to come down as much as it did last year or the year before. So it's more sluggish of a marketplace. The caveat to this is we have to watch what happens to rates. We're right now bouncing right at just above 7%. So we're just above it. Now, that probably is how the rest of this year is going to play out, is right at 7%. The only thing that can bring this material down is next month's jobs report. That will be the first week in February, and it will be the first Friday in February, which is February 7th. And then if we get a jobs report that comes in less than expectations, then we can drill down below 7%, and that will salvage the 2025 market. So this is a very, very important data point that's coming up.
Absolutely. And you touched on mortgage rates there at the very end. And I wanted to ask you, so let's see, last week, week over week, rates rose by 0.14%. And then this week, from last Friday to this Friday, they fell by 0.14%. So can you give sort of an explanation as to what was happening, what caused this sort of change, and what we could kind of see going forward?
So there were a couple things that happened. We got this gnarly jobs report. This actual time period kind of reminds me of when we had interest rates at that got all the way up to 8% in 2023. And when they did, and that was because of Friday, the jobs report. The jobs report that came out in October of 2023 made it so that it was too hotter than expectations, and all of a sudden we had 10-year treasuries that got up to 5%, and then we had interest rates that got up to 8%. And that is too restrictive as far as interest rates are concerned for the overall economy, and we will see some job loss, most likely in the new builder section. That's not what the Fed wants. So what they did is they immediately came out and started talking about that. So that's what happened last Friday. We had Jobs Friday. Usually it's the first week, but January 3rd was the first week. That was the holiday week. They punted it to last week, and it ended up being the 10th that there was Jobs Friday. So the jobs report came out. It was way higher than expectations. It actually looked like last October. It was like 256,000, and it was supposed to be right around 150. So it was way higher than expectations. And as a result, interest rates climbed quite a bit. And then we got to this week, and it was, so that's why we had interest rates that climbed. And that's why you talked about, where interest rates went at the end of last week. Then this week, we had a CPI report come out. We had a manufacturing report kind of move. We had in a CPI, that's an inflation report. We had core, not headline, but core actually came down unexpectedly. And that was a strong sign. So rates came down further. And then we had retail sales also off. It came down just a bit. But then we had a Fed president, one of the Fed presidents, come out and talk yesterday. And he was doing exactly what they did last time when in 2023, when rates got too restrictive and they were approaching 5%. That's where the 10-year Treasury was getting awfully close to 5%. Fed doesn't like being that restrictive. So this Fed president, who is very, very hawkish, he's talking about how we don't need to do anything. He came out and he was talking about, yeah, we might be cutting a lot more than everybody anticipates. So he was talking to all the markets out there that they don't like how restrictive the 10-year Treasury was getting, as well as how interest rates were getting across the board. So as a result of him just speaking, it talked down the market further, and we actually had a correction yesterday, and rates came down even further. And then today, I think rates went up like 0.01. So so week over week looks almost the same. So that is exactly what has occurred, and that's why we are at where we are at right now. This big up, this big down, and then nothing burger if you look at over the course of the last couple of weeks.
So before we hopped on this podcast, you and I were joking around about this uptick in listings, and what I wanted to ask you is primarily in 2023 and 2024, at least the start of, we heard plenty of chatter in regards to the silver tsunami and how a landslide of homes will enter the market as people age. So, Steve, what I wanted to ask is, how have the demographics shifted over the past couple of years? And are there any trends you are noticing, especially with this uptick in active listings?
Well, since my hair is totally silver, I guess I should sell my home. So that's unfortunately that's not really what's going to happen. Silver tsunami it's going to be more like a dial. I look at it more as like a dimmer switch. You're not going to notice it as time goes on. So the dimmer switch slowly but surely goes higher and higher. Nothing that you can write home about. And it really doesn't manifest itself within our overall housing market until about 2030. So the dial is slowly but surely going up. And then 2030, it's not like all of a sudden people are going to go. It's just going to continue to go up even further. So yes, there will be more baby boomers that will be, they've aged in place, but they're at the point where they have to sell their home or do something with it because they need to go to assisted living. That will happen. It's just nature of life. We all are here living and breathing, and then we will meet our maker down the road. That's just how it works. So you get to a point where you can no longer age in place because it's no longer viable. You can't walk or do whatever. You need round the clock care. Slowly but surely coming to more and more people, and as that happens, that dial will increase. We do need that. The marketplace is starved for more homes on the market. Our population has grown exponentially since 1982. I have this chart that shows how many listings there are across the United States, and we're stuck at this really low level. We had 4 million. We're stuck at right around 1.3 million right now listings, and it'll only go down a little bit more to start off this year, and then it'll go up. But that is really, really low. And then if you look at 1982, 1983, we had 220 million, and now we have 340 million people that live in the United States. Yet you could see that we have far fewer homes on the market today than where we were back in 1982, 1983 timeframe that I'm talking about. That is such a there weren't that many people compared to how many people there are today, and there's even fewer homes available. We need more inventory. So it will be absorbed. We will have better rates by the time this hits too in 2030. So it's kind of like going to be, it's just a needed factor. We talk about we have not built enough. Well, this will help offset some of that by this turnover in housing that will come like a dimmer switch slowly but surely.
And touching on the subject of the demographics and the population shift, is how has the California exodus progressed over the recent couple of years as well?
Well, there aren't as many people moving as before. So there are people leaving California, net Californians that are leaving out of the area. But then when you throw in immigration, it's kind of net even. It's like nothing's really happening. So for our state, it's gotten better than where it was net leaving, including immigration. So that's where things are at right now, and that's only because things have really slowed down. The excess of people don't want to trade in their low mortgage rate that they have and all the equity. That's what they've done is in California, their equity has accumulated to such a gigantic level that when we're talking values going up 30%, these people are sitting on a pile of equity where they can sell their homes and actually go move and buy something all cash. And that's what was happening across the United States. This exodus was just full of a lot of people that could put big, sizable down payments or buy homes all cash. And here, that means you're not struggling if you don't have a payment. You don't have, you own your home free and clear, so you don't have anything other than paying property taxes and insurance. And so, boy, when you remove that expense at the cost of shelter, that's what's very, very attractive to a lot of Californians to leave. You can understand the exodus. It's very, very hard to lure people over here when in Orange County, I just changed the luxury level. It's the only market that we're changing the luxury level. The luxury home is the top 10% of a marketplace. It was 2 million plus in Orange County, like it was in LA and San Diego County. San Diego County last year came up to 2 million because they had an incredible year in 2023. Well, Orange County was one of the hottest markets for this last year. Now we had to redo the price range for luxury. It's now 2.5 million. So there's people coming from across the United States that don't even have a $500,000 house and have to go over here, and we're talking a $2.2 million is not luxury in LA. That just baffles the minds of many. So it's very hard for people across the United States to come this direction. It's much easier for people from this area to go that direction. So that explains a little bit of the exodus that everybody's talking about. It's different. It's very easy to move around anywhere in the United States when you're coming from California. It's just not as easy to come this direction because of how expensive things are at. So that's where everything's at as far as the exodus is concerned.
A question asked by a listener was for our thoughts on a video talking about foreclosures exploding as a moratorium backfires on homeowners. So they touched on topics like foreclosures being up 47% in Q4 of 2024, Bay Area prices falling dramatically, shadow inventories, market manipulation. So you sort of get the gist. I was trying not to scratch my eyeballs while watching the video, but Stephen, what are your thoughts on this very unique perspective?
Yeah. So in me going back and taking a look at it, it's very easy. I actually watched some of the video. I couldn't watch the whole thing because I couldn't stomach it. There's some times where I can't stomach listening to nonsense. And this is one of those sites that had it. Turns out that particular company is a company that does this video, and they make it all this scaremongering, and it's going to build. And what they're trying to do is sell something to real estate agents and people to purchase their lists, because they give these monthly lists of everybody that's in trouble. There aren't that many people in trouble. It's just not true. It's just we're at as far as people being behind in payments, we're at the lowest rate in decades. So I don't know where all these short sales and foreclosures are coming from. That's A. B, we're at the strongest housing stock we have ever seen before. And then, so as far as equity is concerned, good jobs, good FICO scores, all that stuff. So when in listening to the whole entire thing and trying to gauge it all, they were making a whole hay out of nothing. And I couldn't figure out where the data's coming from. But how about you? What were your thoughts? What do you think about this particular video that you threw my direction from one of our clients?
Yeah, it was definitely interesting. I mean, if you want to look for negativity in any sort of industry and anything like that, I am sure that you can find it and it'll always be there. And this is just one of those cases where if you want to look for something about foreclosures or short sales, anything like that, I'm sure this is one of the top channels that'll just pop up because I clicked on their account and it was just a bunch of videos about multiple videos saying worst housing crash in history, prepare for chaos, and all of that. And I mean, like I said, if that's what you're looking for, then you're going to find that answer. But the truth, the positive affirmations, all the good and bad information that you can get from reliable sources won't have as strong of maybe viewership, but that's what we're pushing towards, just getting that right message across. And it's like you said, so many homeowners have just good equity in their homes. We have a record of tappable equity going all the way back in history. I mean, this is a strong, strong housing market that we're seeing today. And just for perspective, if you were to go from 10 homes to 15 homes, that's a jump of 50%. And so stats can sometimes lie to you when you're getting just this big percentage. And not only that, it's out of the entire housing inventory, it is just a teeny, teeny, tiny percentage. So we don't sort of try to pay attention to those things. However, we are always watching foreclosures and short sales. We have it, we have our stats, and we will be sure to let everyone know if we see anything coming. And we will be the first people to say that, okay, maybe this didn't cross our pages as soon as we saw it initially, but we are always on the lookout for these sort of things. That's what, at least my opinion.
Yeah, it is easy to see it in the data, and you could see it in the data coming, just like I saw it before coming because I was tracking all the stuff. If you look at the data, you showed us what 2024 did. The funny thing is you did a post on all the foreclosures for the various different counties and for Southern California and the Bay Area, and the percentage of closed sales that short sales and foreclosures make up, it is tiny, isn't it?
Yeah. Yeah, it's about, I believe, like 0.2% of all closed sales for Southern California, like 0.4% for Clark County, and it's like 1% for the Bay Area. So, I mean, it's like we said, if you want to find it, it's going to be there, but it's just these teeny tiny percentages that can make the headlines and get them more money and more viewership. I'm sure that it works, but unfortunately, that's just not the way that we operate. We try to stick with setting the proper expectations and getting that good and correct factual information to all the people that need such beautiful data that we look at all day long. So, but yeah, so to put the cherry on top, Steve, are foreclosures on the rise?
Yep. Yep. They're on the rise. They're going from, like what you said, when they go from 5 to 7, and that's the kind of what we're seeing. Year over year, it's going up because there was a moratorium on foreclosures. There was like no foreclosures, then there were a little foreclosures, then there's a little more foreclosures. The thing that misses is that you compare it to prior to COVID, and we're not even to pre-COVID numbers. That is what everybody needs to understand. So, the delinquency rate is at record decades lows. So we're going to have a hard time pushing our way up, even to meet where we were prior to COVID. And then if you put it to where we were during the Great Recession, I mean, it pales in comparison. We're talking major differences. It's already a major differences. I pick on Orange County just because I did that report today, and there are less than 10. There's like 6 foreclosure short sales that are total active available today, and there are over 2,000 homes on the market. So it's just a tiny little percentage, and that's pretty much the same across all marketplaces. So While it will be on the rise, it's coming from nothing to a little bit, just a little. So it's a slight rise, and we're still making our way to pre-COVID levels. And many markets it will be a long time before it reaches that.
So, mortgage applications continue to drop in the new year. Rising mortgage rates result in the slowest weekly pace of purchase applications since February of 2024. So, to continue on this negative spin, are we stuck in a rut for the housing market?
No, we're at the mercy of rates, and this is coming at a time. It's very beginning of the year, so shoot, that was still the holiday market up to the first couple weeks of the year. So that's still the holidays. You can't even really count that anyhow. But that's still the holiday market. Holidays don't end until this week, right around now for this weekend. Now we're going into what we refer to as the winter market. So the holiday market, there's just not a lot of activity to go around. Then strap on top of that, since December 18th, we've been stuck above 7%. Last year, we were at 6.7% to start off the year. We had been higher in October of 2023. We were at 8%, and then it got lower and lower and lower until we got down and it started off the year around 6.7%. And the people were excited because rates were at 8. Now they're at 6.7. People are going, this is a good time. So it fueled that. So we're talking about a slow time of the year, and we have interest rates higher than 7%. So there's not a whole heck of a lot of enthusiasm for it. That will change as the market changes, as rates evolve, as the coming year starts to blossom. We just began.
And just for clarification, we are recording on January 17th, 2025. So when we say we are entering the winter market, we'd say right about this time, and it'll go for about, another 2 months?
Yeah, we're looking at winter market goes from middle of January right now. This is the weekend, so we're at the 16th, so 17th, 18th. We get to, or I don't even know. Today's the 17th. So 18th, 19th, 20th is, and President Trump gets installed as the president on Monday. It goes all the way to mid-March. So right around March 20th is when spring begins. I say it's mid-March. So it's March 16th on. It becomes our spring market. So we're in the winter market. The winter market is different. It's actually supposed to be flat, slightly rising inventory and demand that really surges. Now, what we're having right now is, because rates are higher, is demand's going up, but just not at the same clip. And we're having more homes come on the market than last year, so they're starting to accumulate. So we're actually getting inventories that are rising at a faster pace. We'll have to see if that continues coming over the next couple of weeks. And we'll have a pretty good gauge on it, and we'll probably write a report about it as well in a couple of weeks.
And something that I wish I wouldn't have to talk about, but I wanted to ask you, Stephen, with the people that are in Los Angeles, there's been a bunch of articles and news pieces talking about how some people that are renting their homes are now price gouging the people that are trying to look for rentals or anything of that sort. So would you be able to shed some enlightenment on what's happening over in Los Angeles?
Yeah, it's a supply and demand thing, but this is not a time to be taking advantage of these poor souls that have lost their homes. This is ridiculous. So we actually, there's bulletins that are going out, California Association of Realtors, the local associations, everybody's trying to get a handle on it, and government officials are talking about it. It really is nonsense. Anybody taking advantage of people in this particular climate, that's absolutely rude. It's immoral, and hopefully it doesn't continue, and there's enough pressure for people to knock it off, because it's just, you know what, if you believe in God like I do, man, this is no bueno. So I don't know how you meet your maker if you're going to take advantage of other people like this in this time. It's tragic what they're going through, and their lives are literally upside down. So it comes down to supply and demand. There will not be enough supply. There just won't be. There is plenty of demand. So we just need to make sure that prices don't escalate as a result of it. And it's not just these bulletins are coming out in Orange County and in San Diego and Ventura because they don't want the neighboring counties to do the same thing also. It's like I don't know why we have to remind everybody not to do that, but it's quite simple that if you know that somebody is coming from one of these fire damaged areas, take care of these people for Pete's sake. And we shouldn't be lopping on a higher price because there's not enough available. They have families that need to move on, and these families can't necessarily live in these big apartment complexes. They want to live in a home, and there's just a real lack of residential leasing that's out there. So that's where the issue's at, and we'll see how this all plays out. But hopefully, the best of human beings comes out.
Now, to switch over to some study done by Zillow, Hartford, Connecticut, and Richmond, Virginia are the rising stars to watch in 2025. Sellers there have the upper hand as homes fly off the market at record speeds. So, do you agree with those two spots being the hot spots to watch in 2025, or do you have some different hot spots nationally to look forward to?
Yeah, it's actually the Northeast, the Sun Belt. Excuse me. You have to keep in mind that it was Idaho and it was the Sun Belt. It was California all the way along to Florida, and where they had the most heat and prices going up because of a real lack of inventory was in Texas, like Austin, as well as Boise, as well as many areas in Florida. They really saw giant increases, and they were building like nobody else's business. A lot of building going on. Well, now that they built a lot and so many people went and prices went up as high as they did, they're actually seeing a lot more inventory, and it's starting to come down. There's various new reasons and nuances to each one of those markets as to why they're really slowing down. But I'm not going to get into the weeds talking about that. Just know that there's pressure on pricing there as long as these interest rates remain where they're at. And that's where this market is. Now, Northeast is a different story. And that's why you see these Hartford, Connecticut, and Richmond, Virginia. That's that Northeast corridor that we're talking about that's been quite hot. And it's a really good marketplace compared to the rest of the country, that whole quadrant up there. So, I mean, yeah, you could definitely cherry pick a couple like Hartford, Connecticut, and Richmond, Virginia, but there are plenty of markets up there that are having the same issues. It's just that those are the headline big metros, but there's plenty up there that they just have a supply and demand issue. They just have people that already don't move as often, and demand has been up there with very, very limited inventory, and their inventory has not grown much, and that's kind of the predicament that they're in the Northeast.
So affordability is pretty much just the talk of the town as rates are hovering around 7%. So, and especially going into this new year, can we see any improvements with affordability as the year progresses?
I hope so. What I'm rooting for is the common American, and the common American, many of them want to list their homes, and many Americans want to purchase a home. There are a lot of millennials and Gen Zs that have wanted to purchase a home for quite some time, but their 4 million sales per year is not enough. We should be doing, it's like 5.1, 5.2 million sales per year. And instead we're doing 4 million, which means there's a lot of sales not taking place because they're priced out of the market. They're priced out of the market with these 7% plus interest rates. The only fix to this is rates to come down. So that's what I'm hoping for. And it's so that there are more Americans that can do what they want to do. So a lot of people don't know how bad it is within the real estate marketplace, but that's what it is. There's a lot of millennials and Gen Zs that just simply can't purchase because of the high cost and unaffordability issue. And the only thing that will really fix that is for rates to come down, because we're not going to see values plummet. That's not going to happen. Even if values come down, it's only going to come down slightly. That's not the fix. Incomes aren't necessarily going to all of a sudden go up 50% so they can all of a sudden afford a home. That's not what's going to happen. The only thing that can really help at this point are rates to be lower. And it really opens up the number of Americans that can afford a home once interest rates drop. And if they drop all the way down to the like mid fives, let's say 5.5%, someday. When they get down there, it is adding millions of more people, households that can now purchase a home. That will make a difference in the marketplace, and that's what I'm rooting for. I'm rooting for a difference in the marketplace, so the more Americans can do what they want to do and not be stuck with these high rates, which precludes them from doing anything within real estate.
Well, that concludes today's 40th episode. So thank you everyone again for tuning into another episode of Let's Talk Housing. If you want to learn more about what's going on in the real estate industry across SoCal, Bay Area, Phoenix, or Vegas, feel free to check out our YouTube or subscribe today at reportsonhousing.com. Please leave us a fantastic review. We'd always appreciate it. And if we didn't get around to answering any of your questions, or if you have any questions, please feel free to just reach out to us on any of our social media platforms, or you can email me personally at info@reportsonhousing.com. We will see you very soon and have a great rest of your day. Thank you.
Thank you.